This morning, the Bank of Canada has announced a rate hold, and this is the same pattern that they've held since September 2023 when the overnight rate was 5%. Now, one of the main reasons is they're not seeing the inflation numbers come down, their target being 2%, and inflation is still showing at about 2.8%. However, what is going on here behind the scenes is your housing price index, the part of CPI, the consumer price index, that is being affected by housing and rentals. That is holding up because obviously interest rates are staying steady and they're staying higher than they have been in the last 20 years. So the mortgage payments based on higher interest costs is a part of the consumer price index. And that is having an effect on the other side of consumer price index, goods, services, commodities, which are falling. And in my opinion, I don't think they're falling based on any action by the Bank of Canada. So there's a lot of moving parts going on with today's rate decision. They are preparing, at the time of this recording, about to have their press conference and discuss what they're going to do possibly in June. But here's the big point. The Bank of Canada and their monetary policy can only be anterior to what happens in the free market. As prices go up and as the economy increases in velocity, then interest rates are soon to follow and going up to slow the economy down. And when prices go down, then the Bank of Canada drops their rates in order to slow down or increase the viscosity of the economy. The first problem is that the Bank of Canada monetary policy, one might argue, is it even worth having a bunch of people sitting in an ivory tower trying to decide what your costs of your goods should be? Or should you determine at what price and what things are produced in the economy? Ludvig von Mises says that the consumer should be the king of the economy, not somebody trying to manage the economy. We call that directed socialism almost, or some form of market intervention. And that's what we have here in modern Canada. The final point here, though, is that it takes time for a monetary policy to filter through the economy and have its effect in the economic environment. So if rates were pushed down, does that mean that all of a sudden we have massive inflation tomorrow? No. What that means is that eventually we see the direction of the economy moving and reacting to what the Bank of Canada decisions are. Here's the thing. If the Bank of Canada decides in June to lower the overnight rate, say a quarter point down to 4.75 or a half point down to 4.5, that doesn't necessarily mean that all of a sudden we're going to have an immediate uptick. This is going to take time. I think that the Bank of Canada is going to be late to the party, and they're going to be too late to the party. Our economy is struggling. The free market has not been allowed to create the supply of homes and rentals based on municipal regulation, based on provincial crackdown on short-term rentals. There's a lot of property rights issues going on there. So today, Bank of Canada standing pat at 5%. We look forward to seeing you again soon. For more information on economics and politics and what ticks and lunatics, follow us at IBCanada Group.com or follow us on this YouTube channel.